first, your take on China, US, and how it factors into your investing thesis.
Yeah, so it's a tricky one to navigate, clearly, Caroline. Our portfolios have about 3 to 5% exposure in terms of revenues to China. So we've been very careful about it. And of course, the companies that have tended to underperform in the last year have been the companies that do actually have exposure to China, not just in technology, but across the board. So I'm not as concerned about the $27 billion chip fund that China's starting. I mean, I think that's pretty much what Intel spent in terms of R&D and CapEx last year alone. So it's a drop in the bucket, but you do have to be aware and conscious of the fact that there are going to be continued hostilities, if you will, trade hostilities.
Which might factor into whether or not we pull back from these record highs. Nancy, we are talking to you when the Nasdaq's at a record high, the S&P 500 is at a record high, global world index at a record high, thanks to the likes of Nvidia. It's interesting that we have Broadcom, for example. I know you've sort of called it the poor man's version of an Nvidia, but there is some weakness in that name after its earnings. How are you ranking the AI frenzy and the chip names to be owning?
So I think I've shared with you our investing theme is old economy companies that are embracing AI, and then the suppliers of the picks and shovels. So we have been expanding our exposure. We trimmed back on many of the names, including Broadcom and Palo Alto Networks a number of weeks ago, and then again yesterday. And so I think you have to be disciplined in this environment. We still own plenty, but we've been adding to names like AXP. I have a AAA or A cube stock pick for you, and it's American Express, which is using AI to improve fraud detection, and then Amazon and Adobe, the unsung hero, we think, of AI. So you have to pick and choose and navigate around and really focus on domestic revenues if you can.
The thing about Broadcom is it's not a maker of AI accelerators, right, Nancy? It has a custom silicon business, makes TPUs, but it's really in the server design build out. You know, it provides networking tech. But they had this specific forecast that AI will be 35% contribution to revenue, up previously from 25%. Does that signal anything bigger to you about how continued or sustained the AI build out is going to be?
I mean, you have to piece together from a lot of different companies, but I think that the security I have in owning a name like Broadcom is that Hock Tan is consistently underestimated. We were buying the stock at $200 a share when he did the Computer Associates deal, and everyone hated it. It was accretive in a year. So there's more to Broadcom than just AI. But if you look at the use cases, almost, we're sitting on earnings season. Everybody's talking about it across sectors, but they're really using AI. And I think that's why I think this market is analogous to the 90s, because we are going to continue to see productivity improvements, and that's going to drive stock prices higher. I would just point out, I didn't answer Caroline's question. I mean, if you look at the all-time highs, yes, that's true, Caroline, but over the last 2 years, if you went 22 to 23, the NASDAQ was actually down something like 3%. So we're not in nosebleed territory yet.
Well, the difference is the contribution from Nvidia. Nvidia's at $927 a share. Stock split Nvidia?
Yeah, please.
So you would favor that? You think they'll go for it?
I mean, they've done it before, so I think it's likely. I think it would be great if Broadcom split as well, and some of these other stocks that trade at these, really high levels. It makes it harder to manage portfolios with them in the portfolio, harder for the retail investor. But, we'll take what we get. We'll take dividend increases. We'll take share buybacks, whatever it takes to drive the stock price higher.
And let's talk about the retail investor. You clearly care about them. You've been writing books for them, and you've also been looking at, well, now we've got an actively managed ETF coming from you at the moment, Laffer Tengler Equity Income ETF, high-quality, large-cap stocks that have strong earnings and dividend growth potential. What is your edge here, Nancy? Where do you want to be showing and offering to this clientele?
Yeah, so this strategy is very different from what you would normally think of as an equity income portfolio. There's no electric utilities. We own one REIT in the portfolio, but we buy what I call fallen angel growth stocks, and we do a lot of research because everybody knows the problems when the stocks are out of favor. So we have our own proprietary research model and our own proprietary valuation metrics, and that is the one we use in that portfolio is relative dividend yield. In these companies, management sets the dividend based on what they think long-term sustainable earnings power is. So it's a total return strategy with dividend growth as the focus, and it's a great workhorse strategy. I have, the majority of my assets in this strategy. So you don't get to own some of the sexier names, but you do get really consistent risk-adjusted returns that have been able to generate excess return above the benchmarks over time.